afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Al Bank Malaysia. Our guest today is Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, and he's dialing in out of Singapore. Now, Vishnu, as always, great to have you on the show.
Always a pleasure to be here, Brian. Thanks for having me today.
Now, Vishnu, for a start, before we get your insights, we'll first take a look at crypto markets and then how regional stock markets have performed in the first half of the day. We've got Bitcoin, which is at 42,167. It's down 1.33%. Ethereum is at 3,170.84. It's down 2.51%. Now, across the two regional stock markets, we start close to home with the SGX. It's at the Straits Times Index is at 3,362.02. It's down 0.63%. In regional markets, it doesn't fare that much better, although the KLSE is at 1,608.62. It's up 0.08%. But Shanghai is at 3,195.02. It's down 1.75%. The ASX Ordinaries is at 7,766.7. It's down 0.07%. The Nikkei is at 26,761.5. It's down 0.83%. The Hang Seng took a battering today. It's at 21,323. It's down 2.51%. And rounding up the numbers, we've got the Kospi, which is at 2,690.69, 0.89. It's down 0.36%. Now, what's your view, Vishnu, on the market performances in the first half of the day?
Well, I mean, it does look like there's certainly a mix of factors that markets are considering, but it does look like we cannot lose sight of the yield locomotive that's ruling the roost. We've had 10-year yields, 2-year yields, essentially US yields moving up dramatically. Already this happened last week, and we saw 10-year USD yields ending at 2.7, and it looks like this week 2.8 could be threatened, and that's coming off the back of two things. One is last week during the FOMC minutes, they suggested that the balance sheet runoff could be at about 95 billion a month, unprecedented. So that's a huge liquidity drainage. Over the weekend, we've had Fed speakers suggesting that the Fed should easily and sooner rather than later get to quote unquote neutral rates, and the guess is that's anywhere between 2.5%, perhaps even 3%, and that's I think reinforcing expectations that a lot more rate hikes could be coming through sooner, faster than some of the more dovish aspects of the markets as anticipated, which is why tech stocks are taking the biggest hit, because high interest rates or being liquidity starved, cash starved, impacts tech the worst. But broadly speaking, higher financing costs and for some of the more introspective aspects, parts of the markets, the risks of a policy mistake leading us to a hard landing. These are the types of worries that are probably seeing either opportunistic profit taking or caution that is warranted.
Okay, Vishnu, I want to take a look at one of your charts. And is yield inversion still on the cards? Is that still something that we need to worry about?
I mean, that's a great question. And maybe this is the point of time it's worth noting two things. In the very near term, we may not talk so much about the yield curve inversion. And to be very clear, when markets typically refer to inversion, they are referring to the specifics of the 10-year, 2-year spreads. And that is, for the purposes of this chart, that's on your rate line. We can usually paint it with a broad brush because typically, all the spreads tend to move about in the same fashion. But this time around, something interesting is happening. The Fed is saying, 10-year, 2-year, they're saying is spurious. They're saying, look, it doesn't matter. What matters for them is they're taking the very short end versus the 18-month, which we can proxy here with the orange curve, which is the 2-year, 3-month spread. And they're saying this guy is going the exact opposite way. So they're saying, in terms of as a canary in the coal mine, they're saying you're looking at the wrong bird cage. That's what the Fed is saying. And in the very near term, what's happening is because of the balance sheet runoff, 10-year yields going higher, we also get a little bit of relief from inversion. But this is a space to watch because I think this discussion will come back quite soon, maybe sooner rather than later, to quote the Fed.
Now, Vishnu, I want to get your opinion on some of the data, the producer price index data out of China, as well as the consumer price index, which were both above expectations. What's your take on that this morning?
So that would be defined by a lack of surprise. We've seen a few things happening, right? We've seen, of course, the price shocks on a global basis, those are very hard to ignore. And China is not exempted from these. And we've also seen the COVID lockdowns, which to some extent exacerbate some parts of this and maybe mollify other aspects where there may not be as much online shopping, so on and so forth. But the big picture remains this. The big picture is China retains the ability to compress CPI with respect to PPI better than most nations, and their policy will continue to be guided, or rather unimpeded, by inflation. Nevertheless, they also have to deal with some of these price shocks that come through.
Now, Vishnu, what are some of the other key points and risks that you want to highlight from your commentary this morning?
Well, I think for this week, there's going to be a lot of policy focus. In particular, after the minutes of the ECB last week, this week we're actually watching the ECB. So the two things I think market watchers are looking for is A, do they end their asset purchases much sooner rather than Q3? Do they do it in June? And B, whether they are also going to bring forward rate hikes, in which case you can see a bit of a knee-jerk upside in the euro, but there's a lot of volatility around that with French elections, with the ongoing Russia risks, both of which may weigh on the euro. We've also got US CPI that markets are going to obsess over because of the Fed's hawkish stance. As we were discussing earlier, this is rearranging the deck chairs on the Titanic. Any lower print, markets will focus on pipeline risks. Any higher print, they'll just double down. So it's all about a hawkish Fed that probably cannot be swayed by data in the very near term. We've got MAS meeting. We expect the MAS to be quite hawkish. The interesting aspect of this is that could, if we are right about recentering of the midpoint, the Sing dollar can jump, and typically the Malaysian ringgit, to a lesser extent Thai baht, are somewhat correlated. So you could see at least a knee-jerk jump in these currencies, but beyond that, dollar is the one calling the shots. So dollar trends will dictate the rest of the weeks ahead.
Now, Vishnu, as always, thank you very much for taking your time to be on the show.
Pleasure is mine. Thank you for having me.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, on BizTech's Asian Midday Market Watch, powered by Al Rajhi Bank Malaysia. I'm Brian Fernandez. This video will be on our various social media platforms, as well as our website, www.biztech.asia. This will also be on Al Rajhi Bank Malaysia social media platform. Thanks a lot for tuning in.